And so I wanted to take this opportunity to really discuss dividend growth rates in more detail. I want to discuss how they apply to the various sectors and which ranges I'm comfortable with when I purchase stocks in the various sectors. Hey everyone, it's Ian. I'm back with another video about dividend growth investing. Today's video is yet another response to one of your questions. Thank you for bringing those questions my way. They fuel the discussion on my channel about dividend growth investing, and I really appreciate them. So today's question is a really good one. It's a recent one, and the subscriber asked me, hey Ian, you always talk about companies that raise their dividend 7% per year in perpetuity. But when I go out there and I look at stocks, that's not always the case. They vary quite a bit. And Ian, I was wondering just what are the acceptable ranges of dividend increases over time that you have come to experience? I really like this question because oftentimes it's easy to simplify things. And I use the 7% benchmark, quite frankly, because when I'm discussing dividend stocks on my channel, I'm thinking about my favorite industry. And that industry is consumer non-cyclical, and also healthcare as well a bit. And for world-class consumer non-cyclical stocks and healthcare stocks that are doing really well, that will likely continue to do really well, 7% or thereabout, that's about the range that I have seen for the best companies. They can grow their dividend each and every year over time in perpetuity. Now, sometimes it falls between 5 and 7%. Sometimes it might dip as low as 4, but that 7%, those companies can do it. And so when I'm talking about dividend increases over time, I'm oftentimes thinking through that precise lens. However, this question comes from someone who's analyzing all of the sectors, and as someone that owns over 30 stocks, I have representation in most sectors out there. And so I wanted to take this opportunity to really discuss dividend growth rates in more detail. I want to discuss how they apply to the various sectors and which ranges I'm comfortable with when I purchase stocks in the various sectors. Now, I recently did a video about PE ratios, and I did a similar analysis by sector. What are the acceptable levels of PE ratios, bear markets, bull markets, where I feel okay buying? And I want to do something a little bit similar today for the concept of dividend growth rates, because it's these types of videos that help myself and help everyone out there when they're analyzing a variety of stocks, just to have simple filters that help narrow the range and help narrow a universe of selections down to a few. Now, I do challenge you with this video and with my PE video to come up with your own ranges, but I want to share what's worked with me today. So, as I always do, I've got my notebook, and I'm going to dive into the points that I jotted down right now. So first and foremost, there are some factors that influence dividend growth rates. The first one is sector. Different sectors characteristically experience different dividend growth rates. For example, the utility sector is a very slow and steady sector, very safe, but the dividend growth rates aren't very high. Whereas, as we already had discussed, consumer non-cyclical, still pretty safe, not quite potentially as safe as a utility, although I argue that it would be. And the dividend growth rates tend to be higher. So it's very sector specific, and you'll see this in a minute. I'm going to go through the sectors one by one, at least some of the representative sectors from my personal portfolio, and how I've seen dividend growth rates in those various sectors and the rates that are acceptable to me. But again, it's very sector specific. So one is analyzing stocks. They have to keep that in mind, that what type of dividend growth rate should I expect? Well, what kind of sector am I looking at? What market sector am I looking at? Another thing worth mentioning, dividend growth rates are very particular to the payout ratio. Payout ratio, simply put, is the percentage of net income that's being paid out as dividends. And so if a company is paying out 100% of earnings as dividends, payout ratio is 100%. If a company is paying out half of their earnings as dividends, payout ratio is 50%. What I've experienced is if companies are newer to paying dividends, if the payout ratio is not very high, maybe it's like in the 20s or 30s, these types of companies can raise the dividends quicker. If a company has been paying dividends a long time and maybe the payout ratio is somewhere between 50 and 75%, dividend increases are going to tend to be a little bit slower unless they experience a surge in earnings growth. And that always happens. Companies go through cycles, even non-cyclical companies. Payout ratio also tends to be tied to market sector. So certain sectors like utilities tend to pay out, have very high payout ratios. Certain sectors like technology tend to skew on the lower side. And so dividend growth, again, it kind of comes back to that sector-specific argument. It's very sector-specific, but it's also payout ratio specific, because even within a sector, you can see some variance with payout ratios between different companies. The third factor that I want to mention is starting yield. And starting yield, quite simply, is the yield one experiences when they first purchase a dividend stock. There's been no dividend growth yet. They're just experiencing the initial yield when they just buy the stock. If a stock is portraying a high starting yield right now in the market, oftentimes it's also a reflection of a higher payout ratio. It's oftentimes a reflection, too, of the sector that it's in. And so with a high starting yield, oftentimes there's less room for growth, whereas companies that have a low starting yield, there's oftentimes more room for growth. Now, I'm making some generalizations here, but I just want to point out that this is the general framework. When one approaches dividend growth investing, they approach different opportunities, that there are really three things, in my opinion, that affect the ability for a company to experience future dividend growth. And those really come back to the sector that they're in, the payout ratio, and the starting yield. And starting yield is probably the least precise one, because starting yield is also just a reflection of the valuation of the company and whether the company is on sale or it's overpriced or it's fairly priced. Share with you today what I have come to expect with various industries. So again, with consumer non-cyclical, I strive for 7% dividend growth rate in perpetuity. Certainly over the last 5-10 years when I'm analyzing historicals, will I go lower than 7? Yes. Anywhere between 4 and 7 is acceptable. Going above 7, it happens sometimes, but it's not very characteristic. It's not very sustainable. But anywhere between 4 and 7, that's a range of a world-class consumer non-cyclical that I would personally be comfortable with, although I try to skew towards the stocks that are in that 7 range. Healthcare, same thing. Very similar to consumer non-cyclical. I'm looking at similar ranges. Let's look at, though, at an industry that's a little bit different. Technology. Technology stocks, the type that I like to invest in, the big ones, publicly traded, they're newer to paying dividends. Most of them have lower payout ratios. Because the payout ratios are low and they're newer to paying dividends, they can raise the dividend quicker. The starting yield is also very low. They tend to pay lower dividend amounts, lower percentage yields. I'm looking for tech stocks that can raise the dividend at least 7% a year, 7% or more. So that's a sector that's a little different. I hold it to a different benchmark. I don't want to get into a tech stock with a low starting yield and see like a 4% dividend growth rate over time. It doesn't do it for me. It has to be above 7 for it to get high enough yield on cost where my eventual yield can be actually used to pay for stuff. Otherwise, it's just never going to get there. So tech stocks, I need a very high dividend growth rate. Utilities. Utilities tend to have a very high starting yield. Regardless of the market, bear market, bull market, utilities always trade with higher yields because they tend to pay out most of their earnings in dividends. And they can do this because they're regulated. These are regulated utilities. It's going to be impossible, next to impossible, for a competitor to come in and disrupt them. And so they have a very stable business model, one that the company works very closely with the government to push through price increases, very collaborative with the governments. And so with a utility, one cannot expect a high dividend growth rate. And I do own some utilities, but typically I like utilities that can grow the dividend. And typically if they can grow the dividend between 1% and 2% per year, that works for me. That's certainly a situation where I would be comfortable. Obviously, after analyzing everything else that I analyzed, but on the dividend growth side of things, the dividend increase side of things, 1% to 2% would be spot on for the utility sector. Of course, coupled with a very high starting yield, higher than other sectors in the market. What else? Let's look at another sector, energy. Energy really differs by market. Starting yields, when I did most of my purchases in the energy sector, were pretty sky high. And because the starting yields were so high, because it's cyclical, this would be the one sector where I'm okay with no dividend growth. And I would say in the short run, obviously these companies will return to growing their dividends at some point, but I'm willing to sit through, let's say, 10, 15 years at this point of no dividend growth, because the starting yields, when I purchased at least, were so high. Now, some of these stocks have recovered now, so starting yield is not quite as good as when I purchased. But I would say energy being so cyclical, being so much uncertainty around the price of oil, for example, I am okay. This is the exception with very low or no dividend rate increases. Industrials. These are the companies that make elevators, they make parts, they make all kinds of B2B type stuff. Let's say like HVAC systems, that type of stuff. B2B sector, I have experienced in that sector less dividend growth than in other sectors. That being said, I like a lot of these companies because they tend to trade at really low multiples, lower PE ratios. They tend to be perpetually oftentimes on sale as compared to other sectors. So there's a lot of factors. And also their payout ratios tend to be reasonably good. For all of these reasons, I'm speaking very generally here, but in that sector, in industrials, I'll tend to be okay with a dividend growth rate of around 3 to 5%, that range. That range works for me with industrials. Retail. Retail is an industry facing disruption. It's an interesting one to invest in. I do own retail in my portfolio. I think retail these days is a winner-takes-all strategy. And needless to say, the dividend growth rates are all over the map, but for the kind of risk that is associated with investing in retail, I like to invest in stocks in retail that have close to a 7% dividend growth rate, year in and year out. Now, will I dip as low as 3%? Maybe 3 to 7% range. But again, 7 is kind of that golden benchmark for retail for me. Restaurants. Similar to retail, I really strive for 7%. Will I dip anywhere between 3 and 7%? Yes. Is there a cyclical nature to these restaurants over time? Yes. Is it a risky sector? Is it a sector that's always turning over? Yes. Is it a winner-takes-all type of industry? Again, yes. So I look at restaurants very similar to retail. I'm in that 3 to 7% dividend growth rate, skewing towards 7. 7 is where I'm really looking for. Finance. I'm not very overweight in the finance sector, although I do have a few holdings there. And I would say in the finance sector overall, I have come to experience a slower rate of dividend increases. It's just characteristic of the industry. This goes back to my original point that it's industry specific. Just in the finance sector, one is hard pressed to find the higher dividend growth rates. Finance, I've come to expect anywhere between 2 and 5%. And it's because of this that finance is not a cornerstone of my overall strategy. REITs, real estate investment trusts. Starting yields are really good. Because of that, because also it's just a slower paced industry, slower growth industry, it's going to be somewhere between 2 and 5%. REITs are going to grow their dividend on average between 2 and 5% per year, and I'm comfortable with that because of the very high starting yields. So to summarize here, there are really 3 factors that affect dividend growth rates. One is the sector that you're in, one is the payout ratio, and one is the starting yield. And for me, I always talk about yield and dividend increases in videos. I'm always shooting for that 7%. And I can do that in most sectors that I invest in, specifically in consumer non-cyclical, technology, retail, restaurants, sometimes industrials, but not as frequently. But there are other industries that are represented in my portfolio where striving for 7%, it's just not going to happen. And sometimes that's fine because the starting yield is so high and payout ratio is so high already as it is. And so there's certain industries like utilities, like energy, for example, like finance, REITs, real estate investment trusts, where I'm okay taking less than a perpetual 7% increase in my dividend year in and year out. And then there's industries like technology where the starting yield is really low, payout ratios are really low, and so I want at least 7% or more. I hope this video was helpful. I hope it answered the question, the subscriber question that came in, and it gives just a framework of how I personally like to look at dividend increases over time per industry. Thank you so much for watching. If you enjoyed the video today, I please invite you to subscribe, to like, to give a comment. These comments fuel these videos, and I'm forever grateful. My name is Ian Lopuck. I'm from ppcian.com. Please note that I'm not a licensed investment advisor, and today's video is not investment advice. Today's video is just for your fun and entertainment. And if you are going to go out and invest capital in the stock market or anywhere else, please do consult a licensed financial advisor first. Thank you so much for watching, and I will see you in the next dividend growth investing video.